All right, guys. In this video, we are going to do a fun little experiment or some diagrams to show you how the banking system actually works, right? And so without further ado, let's just immediately dive into this video. Banking system. All right, so what is the banking system, right? Let's uh, let's draw this box right here, right? It represents the banking system. And so, what is the banking system? The banking system is comprised of various different, commercial banks, right? Interconnected through like a money transfer system, like the SWIFT system, right? Or the ACH system. And so, let's say this is in the U.S., right? If you're outside the U.S., these banks, specific banks won't apply, but obviously your own country has its own commercial banks, right? And so in the US, you have, say, Wells Fargo, Charles Schwab, Citibank, Chase, etc., right? And so for the simplicity of this demonstration, we are going to just say the entire system is just called the banking system, right? Obviously, within the banking system, there are individual banks, right? And let's say there is just starting out, there's one person, right? Alice. Alice has $100, which she deposits into the system, right? So Alice deposits $100 of her savings into the banking system. Let's say Bob walks into his bank, right? It could be the same bank, it could be a different bank, but they're all part of the same banking system because they're all connected, right? Bob walks into a bank and he wants to take out a loan, let's say for $90, right? What does he do with that loan? Hypothetically, I don't know, let's say he goes out and buys like an iPhone or something, right? So Bob goes to his, this other seller. Let's say his friend is like Charlie. And Bob gives $90 to Charlie in exchange for an iPhone, a used iPhone, right? And so Charlie now has $90. What does Charlie do with that money? Charlie takes that money and just simply deposits it back into his bank, right? Right. Charlie could be like in a different bank, but it's all part of the same banking system, right? So do you guys see kind of the magic trick that has happened already? And so initially, the total initial monetary value equals $100, right? Because Alice was the only one who put money into the system. But now, what happened now? So after Bob took out a loan and bought some money and gave to Charlie, right? And Charlie deposited money back in the system. What happens now? Remember, there's only $100 in the system, but now Charlie has claims on $90, and Alice has claims on $100. Alice's claim, right, equals $100. Charlie's claim equals $90. So where did this magic money just come from? Because there's only $100 to start on the system, right? And now the total claim on the system in the form of deposits, which is essentially an IOU from the bank, right, is $190. So where did the extra $90 come from? So This is this is the magic trick essentially that underpins the entire banking system. And what we call this is the fractional reserve. At any point in time, there are more claims than the actual amount of money that's in the system. So every time a bank creates a loan, it is literally creating money out of thin air in the form of credit, right? Uh, Credit, a loan is simply spending money against your future. And so Bob is spending money in the present against his future income, right? That is what a loan is. And so if everything, remember, this system could literally repeat over cyclically over and over and over again, right? Charlie deposits $90 into the system. Dale takes out a loan of $80 against the $90, right? He uses the $80 to buy like a TV or something from Ernie. Ernie deposits his money into a savings account, right? Because he made the money. Ernie deposits the $80, right? So this this cycles of loan origination and credit creation goes on in like basically like in loops so that this $100 initial dollars can create 10 or $1,000 worth of money and credit simply out of thin air. Every time a bank makes a loan, it creates money in the form of credit, literally out of thin air. And so the reason why it's called fractional reserve is because the actual money in the system is not enough to cover the total amount of claims. If everyone tried to take their claims, redeem their claims from the bank would fail because there's not enough money in the system. That is what we call a bank run, right? And so normally this isn't a problem because people are generally good at paying back the loans, assuming nothing goes wrong, right? And so over time, Bob, will earn from his job, money, and then he'll slowly pay back the loan so that more and more money is deposited into the system until there's enough money to cover all the claims, right? But it will never be one to one, right? That's what fractional reserve means. And so if everything goes according to plan, right? As time goes by, people repay their loans, it's okay, right? So what happens if something doesn't go okay? For example, COVID lockdown, right? COVID comes along. What happens? All these businesses shut down, right? Uh, People cannot go to work, right? How is Bob going to repay his loan? How is Dale going to repay his loan if they can't even go to work, right? And so what happens? This entire system becomes what we call a liquidity crisis because these people cannot even pay their loans. But that's not even the primary concern at this point. It's the point that everyone needs money, right, to pay their bills. But if everyone at the same time took claims on their deposits, there is literally not enough money to go around for everyone, right? So this is what we call a liquidity crisis, oftentimes caused by these exogenous shocks to the system, COVID being an example, right? And so how do you solve this problem, right? Who solves this problem? Where is the money to come from in order to satisfy all these claims, right? This is where my boy Jerome Powell comes to the rescue, right? AKA the central bank. So what the central bank does is it gives money, it it also prints money out of thin air, and it gives the transfers of money to the banking system so that the banking system has enough money to satisfy all these claims, right? Because remember, the banking system only has like partial reserves, right? And so how does this central bank transfer money to the banking system? It creates this money out of thin air, right? What does that cause, right? It solves this temporary problem, right? But what happens as a secondary kind of byproduct of this action? Just inflation, right? Because it's creating paper money out of thin air, right? And so when you like go on the news and you see these kind of BS bankers, central bankers, my boy Jerome, tell you that inflation is transitory, inflation is it'll go away. So that's just the whole point, the whole philosophy of the modern capitalist is to basically promote kind of independent thinking, right? So if you to basically enable everyday people to fundamentally understand how the financial system works, right? So that you can come to your own conclusions. And so when these kind of talking figureheads go on TV and say inflation is transitory, you if you understand the system, you know that that's just BS, because inflation is inherently part of the system. Inflation is by definition part of the fractional reserve system, because the fractional reserve system will time and time again encounter liquidity crises where all these people have so many deposits and the banks cannot fulfill them all at the same time, right? In normal operating times, not everyone is claiming money, right, at the same time. And people generally are good at paying the loans. But what happens in these exogenous crises, right? Financial crises, pandemics, right? Many people all want to get their money out of the system, and the people who have loans outstanding do not kind of have the means to basically pay back the loans, right? So that is in a nutshell how the system works, right? It's essentially a magic trick, right? Loans loans equal money creation in the form of credit, right? And so that in a nutshell is how the modern kind of banking system works, right? And so just to clarify, fractional reserve is not inherently kind of evil, right? I mean, there are pros to fractional reserve, right? Imagine if people had to pay with cash on all purchases, right? Not only a small percentage of people will be able to, buy a house, right? Because the amount of money that's required to buy a real estate property, most people just cannot afford that. Within just a couple of years or even like a decade to work, right? People need to take out a loan, a mortgage, so that they could slowly pay back or buy so they could buy the house in the present and slowly pay back the money in the future against their future income stream, right? But just to sum it up, the system is inherently neutral. There are pros and cons to the system, and you just have to understand how it works, right? Because not many people do. And to end this video, I'll put up this quote by Henry Ford, right? Which basically it says that it's a good thing that people don't really understand how the banking system works, right? Because if they did, there would be a revolt by the next morning or something like that. So hope you guys kind of got some good information, got some good insight out of this video, and talk to you soon.